Welcome to the All Financial Hour podcast with Steve All.
The election is over, but we are seeing that the stock market predictions for 2025, they're all coming in left and right, and oh my gosh, can you believe it? They don't all agree. Morgan Stanley believes that the S&P 500 will go up 11% with an outside chance of 30%. However, Goldman Sachs is encouraging people to pull back on risk and diversify. Let's break this down into English, Steve. I mean, how is a person getting ready for retirement supposed to decide when and how and all these different viewpoints?
Well, I think, as you put it, everybody's got an opinion, and very seldom or most of them going in the same direction. So it's one of those things as we start to look at, do we allow emotions to drive our investment philosophies? And my investment philosophy is I want the best return that I can get with the least amount of risk possible. I believe that investing is about need, not greed. And that's what I love about Market Guard. Proprietary investment methodology. It uses non-emotional, methodical, mathematical approach to signaling what we believe are the three most important signals that people are looking for in the market: when to hold, when to sell, and when to re-enter back into the market if I did make the sale, to protect my portfolio from any major downturns like we had in 2000 or 2008, 2009. And when people start to look at it, it's basically the question that's asked is market timing. I believe that the main thing that you have to have in any portfolio is the right ingredients. So when we use this tool called Market Guard, the first thing is kind of like baking cookies. You got to have the right ingredients. I'm not a big fan of vanilla, so I'm going to put vinegar in my cookies. They both start with V, don't they?
Ugh, yikes.
So I think having the right ingredients is very, very, very important. It's important to market return also. The right allocation is also very important. If I put 6 eggs and 12 pounds of sugar in there, is it going to be a very good cookie? No. So I have to have the right allocation. And then I think the most important part that everybody out there is different is how long am I going to keep those cookies in the oven? What's my risk tolerance? Am I more aggressive? Am I a lot more conservative? Because the thing of it is, some people like their cookies soft and chewy. Some like it well done. And so sometimes people just eat the dough. Mm-hmm. But I think what the clients like the most about it is they get to pull those cookies out of the oven before they get burnt. And I think that's what people are looking for. Somebody to assist them, take the emotions out of it.
Personal finance expert Susie Orman. She just loves talking about a successful retirement, which is great. And on her Women in Money podcast, she said that there's one thing that can particularly erode that goal.
It's not just in retirement that you should cut this expense. And I'm just going to really talk about one, but there's one expense that happens over and over and over again. And that expense is eating out. For you to have money, you have to learn to live below your means, but within your needs. You do that by simply purchasing needs versus wants.
That's what I think a retirement plan is really all about. When I sit down with a client, most of my clients, market goes up, not going to change their retirement. Market goes down, not really going to change their retirement. So they are living within their means. That's how they saved the money that they currently have. But then they also get, quote, scared in retirement that they don't want to spend too much and they don't want to run out of money. And I hate to say it. I think one of the things that I absolutely hate to hear the most is when your children come in and they say, I can't believe mom and dad had this much money. Why didn't they do more? My statement of it is what I have to do with some clients is get that bucket list out. Let's figure out what you want to do while you're healthy enough to do it. And if you start overspending, my job is just as much to say, hey, it might be time we want to back off on that. Because I want to make sure you enjoy your retirement, not just sit back, make your own food every night. I love to go out to eat. My favorite thing to make is probably reservations. So, so it goes from there. And I think we all want to live. We saved our money for someday. Guess what retirement is? Someday.
The Federal Reserve meets again on interest rates later this month, coming up on December 18th, if you're marking your calendar here. And it seems everyone's betting on another quarter-point cut. Minneapolis Fed President Neil Kashkari tells CBS News he believes the economy is in a good place and they want to finish the job.
We want to have confidence that inflation is going to go all the way back down to our 2% target. The expectation is that we would do another interest rate cut in December. We need to actually see what the data looks like before reaching any conclusions. But I think another rate cut is certainly possible. But ultimately, if the economy continues to perform well, a strong economy, a strong labor market, that's the outcome that we're all trying to achieve. And I don't think that that's a partisan view. I think everybody's on board with trying to achieve that.
Okay, but, uncertainties can always loom ahead, of course. So how do you help clients build a retirement plan that withstands potential market or maybe even economic turbulence in 2025 here?
I think we have to look beyond 2025 because headwinds and tailwinds are always there. If we can remember back 4 or 5 years ago, the thing that was great was interest rates were at all-time lows and inflation was at all-time lows. Now we're talking high interest rates and high inflation. Now they're bringing it down, but a year ago that was the biggest thing that we were worried about, and we're always going to have things like that. And I think you have to build a plan that has the opportunity to work no matter what happens in the market. I don't want to build a plan that you got to get this high rate of return for the rest of your life every year. Why? Because it's not going to work. And when I build those plans, I found out that one of the common denominators for all the clients was the 3 Ps. Steve, I would like a predictable income. If you can get me that predictable income that I know I can spend every month, I really like that. I want to participate in the market when the market goes up. And I want asset protection when the market goes down. Those are the 3 things that things are built around. And I think if we build our portfolios, which is how we do it, around those 3 Ps, it becomes a lot simpler to do. Because then I am not betting on the market only going up. Because it's not going to happen. Only going down. Not going to happen. We're going to have a combination of all of those things. And I believe that the biggest one for all of them is income, income, and income. Mel says that's the most important thing. And I agree with him because in retirement, the only money you can spend is after-tax income. So when we put together a comprehensive plan, we're going to look at those different things. We're going to look at the fact, how are you going to get an income that you can live on in retirement? How are you going to replace that paycheck? What kind of risk are you taking for the reward that you're getting? What kind of protection do you have? Do you have anything that if we have a negative market, is it going to go down? And then we're going to look at estate issues. Do you have that taken care of? Probably the biggest surprise to me when I got in the industry was the lack of estate planning documents for people when they get. That, folks, is what I call the comprehensive retirement plan. Give us a call. Ask for that. But I do believe the Fed will lower the rates, because they got behind the last time, and I don't think they want to do it again. But the question again is, are you prepared for no matter what the Fed does, what the president does, or what Congress does? Are you prepared?
We spoke about it earlier. Christmas is just around the corner. So is the end of the year, which means many will be meeting with their financial advisors this month to do an end-of-year review to reflect on goals that were set probably 12 months ago. So, Steve, do you welcome this question from clients when they say, what should I be doing different this year? What do you say?
I don't get that one quite as often because of the fact that we meet with our clients, especially the new ones, that first year about every quarter. So we're not pushing it out, and I'm only going to see somebody once a year, and then you got to come in with all of your questions. So we see everybody quite regularly. Beginning of the year, we do beneficiary reviews. Why? Because I think that's important to make sure that your beneficiaries, nothing's changed. This time of the year, we are going to look at those after-tax accounts and see if any tax selling could be advantageous. And then we're going to talk about how the models rebalance first part of January. Why? Because when a model gets out of whack, if I've got an 80-20 model, 80% stocks, 20% bonds, and we've had a year like we've had this year, I don't have an 80-20 anymore. So the models will rebalance in that first part of January. Why? Because I think that's important. Because when markets get too high, what usually happens? They fall. And if I'm overexposed in the equity area, it can cause a problem. Same thing when the markets are too low. Roth conversions. We usually try to get most of the people with the Roth conversions prior to Thanksgiving. But if you're close on that and you need a quick analysis, give us a call. We'll get you in. We'll set you down. Most custodians won't guarantee that they get a Roth conversion through if you do them after about the 8th to the 9th of December. But it's usually possible. Qualified charitable distributions. If you're charitable by nature and you're over 70 and a half, stop giving the money out of your pocket. Give it out of your IRA account. Why? It goes in as a deal. You don't get to write it off as a charitable contribution, but it doesn't count as income for you either. So you have to have that. And then I like to look at people at this time. How's your risk tolerance doing? Has that changed? Do you think you might want to be more aggressive? Do you think you might want to be more conservative? So those are things that I like to look at the end of the year. And it's going to be fun next year because we're going to have different taxes, what we're planning under the current administration, because I don't think the incoming Trump administration is going to allow those tax to, quote, sunset. I think they'll delay it. So we're going to have tax bills next year. It's just what are they going to do? That's what I enjoy watching a year like that, to figure out what we're going to do for taxes for our clients for the next years to come.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisory requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.